Let's talk about American income taxes. It's a topic that affects every single one of us, whether we like it or not. Understanding the basics, and even some of the complexities, can empower you to make smarter financial decisions. Yes, taxes. The thing everyone loves to hate. That annual ritual of gathering documents, deciphering forms, and hoping you don't owe too much. Back in 2017, President Trump signed the Tax Cuts and Jobs Act into law. It was a landmark piece of legislation that promised to reshape the American tax landscape. The core promise? A simpler tax code. The idea was to streamline the process, making it easier for individuals and businesses to navigate the often confusing world of taxation. And of course, more money in your pocket. Who wouldn't want that? The promise of lower tax bills was a key selling point, and an economy ready to roar. The hope was that these tax cuts would act as a catalyst, igniting economic growth and creating new opportunities. The pitch? Filing taxes would be so easy you could do it on a postcard. Imagine that, a tax system so straightforward that it fits on a single simple card. The reality? The tax code is a beast. A complex, ever-evolving set of rules and regulations that can be daunting even for seasoned professionals. And this was the biggest overhaul in decades. A massive undertaking that touched nearly every aspect of the tax system. The law aimed to cut taxes for individuals. Lowering the burden on everyday Americans was a central goal. Families, providing relief to households across the country, and businesses. From small startups to large corporations, the law sought to incentivize investment and job creation, hoping to spark economic growth. The idea was that lower taxes would free up capital, leading to increased investment and expansion. The theory let people and companies keep more. By reducing the amount of taxes paid, the law aimed to stimulate economic activity, and they'll spend, invest, and create jobs. That's the core principle of supply-side economics. But political promises are like New Year's resolutions. They sound great in the moment. Big at first, but often fizzle out. The reality of implementation can be far more complex than the initial promises. Did this law deliver for everyone? Did it live up to its promises of simplicity and prosperity for all? Or was it just another complicated gift with strings attached? A package of benefits that came with unintended consequences and hidden complexities? It's a story of winners, losers, and a lot of temporary changes. Many provisions of the law were set to expire after a certain period, creating uncertainty for taxpayers. So, let's break down what really happened. Let's examine the winners and losers, the intended and unintended consequences. Ready? Let's dive in. It's time to understand the real impact of the Tax Cuts and Jobs Act on your wallet and the American economy. The Tax Cuts and Jobs Act, or TCJA, had two main goals: cut taxes for individuals and slash corporate taxes. For you, that meant lower tax rates and a bigger standard deduction, more cash in your pocket. For corporations, it was a permanent rate cut from 35% to 21%. A massive windfall. The idea: big business tax breaks would trickle down to everyone else through jobs and wage growth. The bill also reworked deductions, credits, and exemptions, like a financial Jenga game. Supporters called it a growth engine. Critics called it a giveaway to the rich. So, was it a miracle or a mess? Let's look closer. Let's talk tax brackets. These are the cornerstone of our income tax system, the method by which your earnings are divided and taxed at different rates. Understanding them is key to understanding your tax liability. They are the tiers that decide how much of your income gets taxed at each rate. It's a progressive system, meaning the more you earn, the higher the rate you pay on the portion of your income. The Tax Cuts and Jobs Act, or TCJA, kept 7 brackets, maintaining the structure of the progressive tax system, but it significantly lowered most rates across those brackets. This was a key feature of the TCJA, designed to put more money in the hands of taxpayers. For example, let's consider a single filer making $50,000 a year. This is a common income for many Americans. Under the TCJA, they saw their top rate drop from 25% to 22%. That's a noticeable difference that impacts their overall tax burden. That's a real, if modest, tax cut for millions of Americans. It translated to more take-home pay and a slight easing of the financial burden. At the other end of the spectrum, the top bracket for the wealthiest dropped from 39.6% to 37%. This represents a bigger cut, and when applied to much larger incomes, the savings become substantial. So, while the middle class got a small break, a welcome bit of relief in their everyday finances, the wealthy got a much bigger one, leading to a larger overall impact on their financial standing. The result? Most people saw a lower tax bill, which for many translated into a slightly larger tax refund or reduced tax payments throughout the year. But the biggest benefits, in terms of sheer dollar amount, went disproportionately to those at the top of the income ladder. Critics argued the law favored the rich, exacerbating existing income inequality and creating a system that further benefited those already well off. While supporters pointed to broader relief, emphasizing that the tax cuts benefited a wide range of income levels, stimulating the economy. Either way, regardless of the political arguments, your paycheck probably got a little boost, reflecting the changes in tax rates. But the distribution of those benefits across the income spectrum, it was definitely not so even. The middle class got a trim, a little off the top, a minor adjustment to their financial picture. The wealthy, on the other hand, got a full-on haircut, a significant reduction in their tax burden. So that's a look at how tax brackets and rates changed under the TCJA. Let's see what else changed in the tax landscape. One of the biggest changes? The standard deduction nearly doubled. For singles, it jumped from $6,350 to $12,000. For married couples, from $12,700 to $24,000. Suddenly, millions could skip itemizing and just take the big deduction. The result, tax filing got a lot simpler for most people. Before the law, about 30% of filers itemized, after only about 10% did. But there was a catch. The personal exemption, a separate deduction for each family member, was eliminated. For large families, this sometimes meant little or no net benefit. For singles and small families, it was a clear win. The law made life easier for many, but not all. Simplicity came at a cost for some. The promise of postcard taxes, closer, but not quite reality. For most, it was a welcome change. For others, not so much. The TCJA also took a hatchet to some popular deductions. The biggest hit? The SALT deduction, now capped at $10,000. This hurt taxpayers in high-tax states like New York and California, who used to deduct much more. Mortgage interest deductions were also limited, now only on the first $750,000 of new loans. Miscellaneous deductions, like unreimbursed work expenses and moving costs, vanished for most. For many, the larger standard deduction made up for these losses. But for upper-middle-class families in expensive areas, the changes meant higher taxes. The law gave with one hand and took with the other. Simpler for most, but costlier for some. A classic legislative sleight of hand. The question on everyone's mind, after all the dust settled, after the ink dried on the new tax legislation, who really came out on top? Who were the true beneficiaries of these sweeping changes to the tax code? Corporations, for sure. Their tax cut was permanent, substantial, and undeniably huge. They saw their tax burden significantly reduced, freeing up capital for investment, expansion, and of course, increased profits. The wealthiest Americans also scored big, enjoying lower top rates on their income and a far more generous estate tax exemption, allowing them to pass on even more wealth to future generations. These changes further solidified their financial standing. The middle class got a tax cut too, about $2,000 a year for a typical family of four. This provided some relief, offering a bit more breathing room in their monthly budgets. But high earners and corporations saw the largest benefits, both in dollars and as a share of income. The scale of their gains dwarfed those experienced by other income brackets. Taxpayers in high-tax states and larger families often lost out due to deduction limits, particularly the cap placed on state and local tax deductions, and the end of personal exemptions, which disproportionately affected larger families with children. The benefits weren't evenly spread. Some gained a lot, experiencing a significant boost to their financial well-being, others barely at all, seeing only a negligible difference in their tax burden. Non-partisan analyses agree. Most people got a cut, but the top 1% got the biggest slice, further widening the gap between the rich and the rest. The law was sold as a middle-class miracle, promising widespread prosperity and economic growth for all. But the biggest winners were those who already had the most, exacerbating existing inequalities in wealth distribution. It was a tax cut for everyone, at least nominally, with extra helpings for the rich, who reaped a disproportionate share of the benefits, and corporations, who saw their bottom line swell thanks to lower tax rates. The result? A patchwork of winners, some celebrating significant gains, others experiencing modest improvements, and losers, those who found themselves facing higher tax bills or minimal benefits, highlighting the uneven impact of the new tax law. Here's the twist. Almost all the individual tax cuts are temporary. In 2026, unless Congress acts, tax rates go back up, the standard deduction shrinks, and personal exemptions return. The tax cut for individuals? Set to expire. The corporate tax cut? That's permanent. Why? To make the bill fit budget rules. So businesses get lasting relief while individuals face a ticking clock. Did the corporate cuts trickle down to workers? The evidence is mixed. Some companies gave bonuses, but most used the savings for stock buybacks. The law simplified taxes for millions and cut most people's bills, temporarily. But it added trillions to the debt and gave the biggest, most permanent benefits to corporations and the wealthy. The real legacy? That depends on what happens when the clock runs out.